The Federal Reserve just released a document that I believe the Federal Reserve is going to use to justify an increase in the dots. That is, fewer cuts, more pain for the markets. But then I was slightly thrown off because I was randomly scrolling and I came across a tweet like this. Here's this Caleb individual who says, I know that disinflation feels questionable with the recent CPI and PPI data. Oh, he's trying to relate to us. That is how we feel. We do feel that way. And then says, but forward-looking indicators in the labor market continue to indicate disinflation will persist. Okay, so he has forward-looking data, he says, that indicates that disinflation will persist, and therefore he will stick with the weight of the evidence. And he quote tweets this Nick Bunker guy who proceeds to post multiple year-over-year wage growth charts indicating that wage growth is falling. But wait a minute, year-over-year measures are not leading indicators. They are lagging indicators. Wait a minute. But the person just said he is going to stand with the weight of the evidence and look at leading indicators. But then he gave me a lagging indicator. Okay, that's not very useful. So, what did the Federal Reserve just release? And how does it relate to this? Well, let me give you a hint. The Federal Reserve just released a paper that actually might be a leading indicator. And it says the exact opposite of what this Twitter poster is suggesting. Now, our first clue that we got over the last few months that, something is changing was actually here in the ADP report. Remember the ADP report all of a sudden showed that we went from 7.2% wage growth in January to 7.6% wage growth in February for job changers? That was our first red flag that, wait a minute, that trend, that plummeting trend of wages might be starting to turn again. And then the Federal Reserve releases this on the same day that Jay Powell is testifying in the Senate. Note that he probably hadn't read this yet, given that it came out probably after he was done in the Senate. Take a look at this. Will the moderation in wage growth continue? Nick T actually tweeted a chart from this, but he didn't go into as much detail, in my opinion, as he should have, given that he just kind of took the chart out of context. But let's actually read what this is. First of all, wage growth has moderated notably following the post-pandemic surge. Great, that's exactly what Mr. Twitter poster says. But it remains strong compared to wage growth prevailing during the years prior. So, what will happen now? Will wage growth moderate or will it stall? Well, this is a really important question. If wage growth keeps moderating, then we can get rate cuts. We're not so worried about inflation. We usually want this to be around 3% to be consistent with 2% inflation. Consumers make up about 70% of the economy, so you got a rough kind of translation there. Anyway, take a look at this. In this post, we use our own measure of wage growth persistence, and it's called trend wage inflation. And what they're trying to do is find out what's happening in the near term that could be indicative of the future. So what they do is they look at the last 3 months and they look at the wage changes in the last 3 months, and then they annualize those out to say, okay, well, if we continue at the speed that we've had the last 3 months, what's the future going to look like? That's very different from going back a year and going, wages are lower today than they were a year ago. Very, very different. So, what do they conclude? And this is the scary part. Ready for this? Let's scroll down over here. The shaded area shows a 68% confidence band, whatever. But it's but there's this chart here, and they're going to give us some takeaways here in a moment. You should already be able to tell them. I added this box on the left, I added this box here, and I added this box on the right. And what you'll notice is we're kind of getting a little stuck in this box on the right. The box on the left was around 3 to 3.5%. The box on the right is around 5 to 6%. Not great, okay? What are the conclusions of the Fed, though? That was just me looking at the chart. What are their conclusions? I want you to keep in mind, this is from the New York Fed. This is these are their researchers providing this sort of insight. A large chunk of wage growth we saw over the course of 2021 appears to have been persistent. It is worth stressing once more that the trend extracted by the model is expressed in annualized monthly wage growth, which explains why it leads the actual year-over-year growth series in the chart. Notice how it's almost like the Fed literally responds to Mr. Leading Indicator over here on Twitter. Anyway, and they're basically like, use wrong. Anyway, and this is concerning to me because keep in mind, I used to be in camp, it's all going to be fine. The trend is down. It's going to keep going. You know, I'd look at these charts and be like, great, we're getting close to rate cuts. This is going to be glorious. Well, then the data started changing. I'm like, oh, no. This is how the second wave starts. Now, I don't know if the second wave will keep going. I don't know that. I do know that I'm looking for my next short, and I'm going to send an alert to all my course members in the Stocks and Psychology of Money group as soon as I place my next short. And I got some juicy targets I'm looking at here. No guarantees they're going to kill it, but I think we're going to have some juicy shorts going into that Fed meeting next week because I'm a little nervous about it. And a lot of people still think we're going to get 3 or 4 rate cuts this year. Not if these numbers persist. The Fed is literally telling you this, but nobody's paying attention to it. Except that's why I'm making this video. I always think my job on this channel is to point things out that other people aren't pointing out, or to try to dispel people's misunderstandings. That doesn't mean everything I say is perfect, but we're gonna at least try. So what do we have here? The model suggests that the trend may have peaked in the early months of 2022, then started declining. The moderation then flattened out in mid-2023. That's bad. And remained stagnant since. Okay, that's a really bad phrase right here. Flattened out in mid-23 and remained stagnant since. However, the shaded areas indicate considerable uncertainty. The recent slowdown estimated by our models indicates it cannot be ruled out that wage growth will be markedly higher in the near term than it was before the pandemic. Notice how they didn't say, oh, it might be markedly lower. They said, hey, it's flattened, progress has flattened, it's remaining more persistent, and it may go way higher. Uh-oh. Now, obviously, we're getting some mixed signals, since they do mention over here that the Employment Cost Index, which is the ECI right here, is trending down. It's that red line right there. Yes, it's trending down. But trend inflation, it's not so much that it's skyrocketing, it's that it's stagnating. It's that we're getting stuck right there. That's bad. That means the Fed has to wait more to actually finish the job. So, what else do we have from the Fed? Well, listen to this. I wrote RIP right here. Many labor market indicators, such as job vacancies or the rate at which unemployed workers find jobs, are still at or above pre-pandemic levels. In addition, persistently elevated nominal wage growth may have repercussions for price inflation. Oops. Although it may be the result of wages in nominal terms catching up with previously high inflation. That's true. It's entirely possible that the reason we're seeing wage growth is because you have high prices. So prices went up and now wages are catching up. So that wage growth falling progress is stalling because people are still catching up. But the question is, when does that become the spiral, right? Okay, so wage growth catches up. Well, are prices then going to go up? Right? That's where you get the laddering of the spiral. That's really bad. I think that's going to keep the Fed extremely cautious. They do not want to repeat the 1970s where they cut too early and then they end up realizing they weren't tight enough and they're going to have to raise rates again. That's when you create a real disaster. Now, our approach offers a way to look under the hood, out through the noise, and while uncertainty remains, our estimates point to persistent wage growth that is still above pre-pandemic levels. Dang it! That's exactly the opposite of what Mr. Twitter dude over here said. Now, in fairness, let's be real. We did just have a CNBC article over here. No thanks, CNBC. We did just have a CNBC piece here. What did we have? Layoffs rise to the highest for any group, basically, any February, since 2009. Okay, that sucks. So, tech layoffs led the way with warnings of 28,000. Now, what's interesting is that number has fallen 55% from the same period a year ago. So I have a little trouble reading this data because they're telling us it's the highest since 2009, but actual layoff numbers have fallen 55% from the same period a year ago. So there's something weird going on here with layoff announcements in February given that the number of tech layoffs have fallen to half. I think it's because all categories together, we might be the highest level since 2009. And that's because of this total 84,000 planned job cuts, showing an increase of 3% from January and 9% from the same period next month. The thing, though, is job cuts don't necessarily mean the Fed is done. Because what happens when companies cut jobs as part of a rebalancing, and then you get a bunch of people taking new jobs? In other words, other companies hiring, the government, healthcare, education, retail, whatever. So yes, you can have more layoffs and more turnover, but as long as you still have more job openings, which we do, well, what difference does it make? I mean, let's consider for a moment the job. Let's try it. St. Louis, Fred, jobs. I'll just do JOLTS. It should come up under JOLTS. Job openings, labor turnover. Here we go. And let's go ahead and pop the chart. Can I get job openings, non-farm? Yeah. I mean, come on. Look at how many jobs we have available. 8.86 million. Compare that to pre-pandemic. 7.5 million. So we have at least another 1.5 million jobs to go before the number of job openings we have actually starts leading to a higher unemployment rate, potentially. Now, I know there could be a mismatch and there are a lot of things here, but listen, all I'm trying to do in this video is tell you the Federal Reserve themselves, this is the New York Fed, okay? They themselves are saying, hey, the moderation wage growth is stalling. We need to pay attention to this because we're trying to use forward-looking data as much as you can for labor because we know that's a lagging indicator, and it makes us nervous. Anyway, let me know what you think in the comments down below. Check out the courses on building your wealth down below. I send all my trade alerts to those of you in the Stocks and Psych group, although everybody in all of the courses gets access to the course member live streams where we go deep with Q&A and fundamental analysis every day. Make sure to also come to the June 21st to 23rd event. And of course, check out my startup, Househack, at househack.com/2024. Thanks so much. And if you're an accredited investor, we are fundraising over there. Just read the PPM. Thanks again. Goodbye.